Georgia. Doug, you're up.
Hi, Peter. In one of your video blogs, I think it was the Fed's non-taper damage control, you were saying that if rates go up, the losses on the Fed's book of bonds will be so great that they'll be sending a bill to the Treasury instead of profits. Is this a figure of speech, or would the actually would the government actually be bailing out the Fed?
Yeah, ironically enough, that's what the law requires. Now, the Fed does not have to mark to market its losses. It only has to count the losses when they're realized. So, but here's the problem. So let's say interest rates go up and the Fed needs to shrink its balance sheet. The Fed has to sell treasuries and buy back currency to shrink the balance sheet, take money out of the system to slow inflation. They have to start reversing their policies. But if they sell a long-term bond at a loss, that loss has to be made whole by the Treasury. So if they hold it to maturity, then there is no loss because they get everything back, unless the government defaults. But if they sell, so let's say the Fed, and thanks to Operation Twist and QE, they've got a lot of long-term bonds. So let's say the Treasury bought a 30-year government bond when the coupon was 3%, and they have to sell those bonds when the coupon is 6%. Well, maybe a $100,000 bond is only worth $70,000. So maybe the Fed bought the bond for $100,000, but when they have to sell it to shrink their balance sheet, they only collect $70,000. That's a $30,000 loss. Well, you multiply that over all the bonds they have. Let's say it's a $300 billion loss. Where's that money going to come from? Congress has to send the Fed the $300 billion. Now, where are they going to get the money? Theoretically, they're going to have to raise taxes or cut government spending to get the extra $300 billion to reimburse the Fed for the money it lost. So all the profits that the Fed is making now, and they're still Warren Buffett is, this is great. They're making all this money. Yeah, they're making less than 3% on equity, but they're leveraged up, and all these profits are going to reverse into huge losses when interest rates go up, which is another reason why the Fed knows it can never tight taper. It can never unwind its balance sheet. There's no exit strategy because any exit strategy would involve massive losses for the Fed. And the Fed can't take these massive losses because the Treasury can't afford them.
Yikes.
Yeah, that's why I said exit is impossible. I mean, how can the Fed sell these bonds without pushing down the price? See, the Fed thought, well, we can sell bonds and there's going to be some magical buyers that are going to come in here and get us out whole. No, the Fed needs to sell. There are no buyers. The bids fall through the floor, and the Fed takes huge losses. I would say to unwind its balance sheet right now, the Fed's got a balance sheet of getting close to $4 trillion. If they tried to sell, let's say, $2 trillion worth of those bonds, they might drive yields on the 30-year bond up to 7 or 8%. So the losses that they would incur in the process would probably be, over $500 billion that they would lose if they tried to unwind that portfolio right now. So they can't do it.
Yeah, I was just I didn't know that there was a law that they had to. But
yeah, Congress passed that law. because I guess they didn't want the Fed to actually be insolvent. So they basically said that the taxpayers were on the hook for any losses that the Fed incurred.